Good afternoon. On behalf of Leonardo da Vinci, Frida Kahlo, and Claude Monet, on behalf of Rembrandt, Picasso, Gerhard Richter, and Cy Twombly, and of course, on behalf of Columbia University and our Masters in Wealth Management program, it is my pleasure to welcome you all to this, our 11th Speaker Series event, where from time to time, we invite industry thought leaders to come and share with us their perspectives on our fast evolving wealth management industry. Our topic today is art as an asset class. And my name is Philip Hecker. I'm a senior advisor to the wealth management program, and I'll be your moderator today. In terms of housekeeping, this webinar is being recorded, and yes, you can enjoy a replay later on the Columbia Wealth Management website. Before I introduce our great panelist who will really bring this topic to life, please allow me a few short words on our Masters in Wealth Management program, and let me give you a feel for the arc of today's conversation. Columbia University's Masters in Wealth Management is a 16-month part-time online program that prepares existing and aspiring wealth management professionals to meet the many disruptive challenges and opportunities that the wealth management industry provides. It is the only Masters in Wealth Management provided or offered by an Ivy League institution, and it also provides our students with all the educational requirements needed to attain the Certified Financial Planner designation. Should you wish to learn more, simply type Columbia University and Wealth Management into a web browser of your choice. And you can also join us on April 17th in our next information session. Find the details and sign up right on our website. And last but not least, please note that the application window is now open for our 6th cohort, which will join us later this fall. With respect to our conversation today, first we'll get to meet and get to know and benefit from the wisdom and perspective of our guest, art as an asset class being the key topic today. Mark has prepared several insightful slides that we will support in this conversation, and towards the end, we'll open it up for a Q&A loop. So please, everybody, students, faculty, and attendees, use the Q&A function at the bottom of your screens to type in your questions, and then I'll be feeding them to our panelist. And with that, it is my great privilege and pleasure to introduce our very special guest for today, who will shed light on this important topic from a number of perspectives. We are joined today by Dr. Mark Bell, who brings a unique blend of perspectives to the conversation, being both a leading researcher and practitioner in this field. On the academic side, Dr. Bell is a senior research fellow at Emory's Center for Alternative Investments down in Atlanta, where he also serves as an assistant professor in the Department of Quantitative Theory and Methods. And on the real-life, practical side, Mark has had a long and successful career in consulting, private equity, and wealth management, currently serving as head of family office and private capital at Ballantine, a leading ultra-high net worth oriented RIA, also headquartered in Atlanta. Mark, welcome. It's great to see you.
Thank you, Philip. It's great to be with you.
Before we dive into art as an asset class, let's get to know you a little better. Mark, our students in particular always enjoy learning about different firms and different positions in our industry. So if you don't mind, spend a few minutes bringing Ballantine to life and paint the picture of your long, windy, and interesting journey into your current position.
Absolutely. So Ballantine is in that world and plays in that world of fiduciary model RIA that serves the ultra high net worth client and family offices. So sometimes we think of ourselves as a multifamily office. other times as ultra high net worth RIA. But what those two circles have in common is that our clients are usually not as focused as at other firms on cash flow planning, but they're more focused on intergenerational wealth strategies, which allows for a very high proportion of alternatives, even to include alternatives to alternatives, things like collectibles and like art, which we'll talk about today. I actually did my background in the humanities at first Stanford and then at Oxford before getting my introduction into the business world by joining McKinsey and Company. And from McKinsey, I was recruited to a very unique position at a firm called D.E. Shaw, which a long time ago was one of the very early quantitative investor hedge funds. And in that role, I had the unique opportunity to have Jeff Bezos' old seat as the head of strategy for that firm, trying to look at new areas of investing. And it was there, Philip, that I first started to do work around things like cell phone towers, timber, rail cars, water rights, music rights, and in particular, art. And art as an investment that we could use our quantitative and statistical methods around. And that quantitative and statistical approach to art investing is part of what the research that we've continued to do at Emory and at Valentine, both through the Department of Quantitative Theory and Method and the business school, and we'll talk about some in our conversation today.
Super interesting. Thank you for sharing that. Great for our students to better understand firms like Valentine. And we appreciate your winding road into the position that you're currently in. That's inspiring to hear. Before we dive into art as an asset class, let's get to know you even better on a personal level. I have 3 quick icebreaker type of questions for you.
Sure.
Speed answers, if you don't mind.
You got it.
First off, favorite books.
Favorite books for business or just favorite books in general?
Any way you choose to answer.
Okay, I'm sorry. I know speed answers. I would say some very important books to me. When I showed up on Wall Street, they said Fooled by Randomness was kind of the important book to understand. That whole lineage of books around the improbable, whether it's Black Swan, Anti-Fragile, are all very high up there. I also am very, very interested in a recent book called The Missing Billionaires, about how investment mistakes have taken some important intergenerational families out of the game. A reminder that, not going backwards is a very important part of our profession. And then outside of investing and statistics, I continue to always go back to and find incredibly fascinating the book Religion and Decline of Magic, which was written by one of my professors, Keith Thomas at Oxford, about how religion replaced magic and how science in many ways has replaced religion.
Thank you for sharing. Great tips indeed. In that spirit, in that vein, to keep current on our industry today, are there any podcasts or websites you like to leverage?
Yeah, it's a good question. I think a well-curated Twitter or X feed is a great way to follow. And but I always encourage my students to try to be as conversant as possible in the financial press. I continue to really enjoy the Financial Times, despite the upheavals and changes in a lot of different media outlets. It continues to be really assuring. I read the daily brief from Oxford Analytica, which I continue to find highly insightful. In terms of books that are new and current, I think the Power Principle is a really interesting one about the new dynamics in venture capital that I'd recommend to students.
Wonderful. Last pop quiz question,
Yeah.
at least for now. If you could invite 3 people over for dinner, dead or alive,
Whoa.
who would they be?
I have to bring the dinner.
Yep.
I would say I would love to talk with Thomas Jefferson. I would love to also have come to that dinner my favorite philosopher, John Locke, and his kind of modern muse, Harvard alumnus and Professor John Rawls. So it wouldn't be that great looking a group, but I think a very interesting dinner.
Interesting dinner of tweed jacket wearing folk
Yes.
indeed. Mark, thank you for sharing all that. Let's dive into the main topic of today's conversation, art as an asset class. Given your background as a researcher and practitioner, you have a wealth of academic and practical experiences. Grateful for your work in preparing some slides to share your perspectives with our crew. So as you take over and
Yeah.
slide share your materials, why are we talking about art as an asset class in the first place?
Absolutely. So I'm going to shift over to my slides. As a recovering McKinsey consultant, the absence of slides is a source of anxiety. So now we're into some slides here. Um, your question, why art, I think is a very, very good one. And as folks who are joining us today, who are advising clients and working with clients, the answer to why art will be somewhat self-evident. And that's because clients are very, very interested in this topic. It's a topic that comes up with greater and greater frequency. And um, the reasons I think are fascinating and go back to, as I said, kind of some of the early work we were doing at DE Shaw on art as an asset and art and portfolios, art arbitrage strategies, art investment strategies. But essentially, art has continued to become one of the things that as humans we're fascinated by, we're compelled to, and that we view as a store of value. And so here we have a diversity of images from, $100 million Basquiat to hay bales to the very, very popular and iconic street art of Banksy. And of course, the $600,000 taped up banana, which raises questions of once the banana rots, is the art gone? Can you replace the banana? All of these interesting kind of things that modern and contemporary art kind of bring us to question. And so in terms of why art and why now, we've really seen over the last 2 decades, alongside globalization, that art has emerged as a global collecting and investment activity. We've seen the emergence of publications. I mentioned the Financial Times in our icebreaker, but the Financial Times essentially has a weekly section now on collecting, increasing the acceptable view that this is not just a passion, but rather an actual legitimate investment activity. And it's important for companies. We've seen recently interesting discussions of with the merger of UBS and Credit Suisse, or the takeover of Credit Suisse by UBS, they now have over a 4,000 piece art collection. And so these corporations, in order to demonstrate, just like individuals, that they get it, that it's important to them, that they understand things that are relevant, find art a really, really important part of an investment portfolio and investment strategy. As I mentioned, this traditionally 30 years ago would have been a market really dominated by New York and Paris, with London playing an important but supporting role. That has changed really dramatically with the rise of Asia. As the slide indicates, in 2000, China was 1% of the global art market by turnover. Today it is 15%. France has diminished really, really substantially as kind of a center for the global art market. And the US continues to be important, as does the London market. So we really have an increasingly global market that reflects kind of a global rise of Asia, in particular China. The market itself, we estimate to be really substantial at over $2 trillion in the global market. You know, that's roughly the size of the amount of silver that we have in circulation. Last year in 2024, we had art and antiquities, but primarily fine art. We had turnover of around $57 billion. That was down. It was down for the second year in a row, but it's still above the 2019 COVID pandemic levels. And that turnover is the GDP of, say, Slovenia. I know you're a lover of travel and fine wine, Philip, and I know you've probably tasted Slovenian wines, but we have an art market that's roughly the size of that national GDP.
Mark, wow, those are big numbers indeed. Before we maybe get your thoughts on what's driving the development, let me make a shout out to Brad, who fielded a wonderful question into the Q&A box already. Brad will address your question in the course of this webinar, and I invite other attendees to type in their questions as well. So with that, Mark, back to you. What's driving that massive size of the art market?
Well, I would say three things really. One, you know, as we talked about a second before, it's truly become a global market. Two, the increased acceptance among participants in that market that art acts as a store of value at a minimum, at a potential way for profit, which we'll talk about in later slides as well. And three, it really has become a must-have, particularly for 30-plus-year-olds. There is some concern that when we see the market have 2 down years following really, really robust years in the public equity markets, that potentially, you know, how can we explain a sideways art market for the last 2 years to a slightly down art market, given that global wealth, global GDP, global prosperity, particularly among the ultra rich, continues to grow. And there, Philip, you know, we can talk about it more in Q&A, but we don't really have an answer. I have a few speculations. I would say one, a lack of direction in contemporary art continues to be the best explanation. You know, street art like Banksy was a massive phenomena in contemporary. It drove prices. We had a very brief but very torrid love affair with NFTs. That drove a lot of collecting activity. We have not really seen leadership in terms of artists who are creating, you know, new and important trends. You mentioned in your introduction a lot of the blue chip kind of household names, but a lot of the collecting activity today is among folks like Richter, like Kiefer, who are kind of well-known, established blue chip names. The second reason I think we might see some slowness is fairs, art fairs, which make up about 30% of all dealer volume now, have become a massive phenomena. Everywhere has an art fair or two or maybe three. Some of the newness and excitement for fairs, I think, might be waning. But the third, and what I wanted to come about to in a roundabout way, is there is a view that the new wealth, the startup and crypto bros and guys who have, you know, made a tremendous, guys and gals who have made a tremendous amount of money in a very short period of time, it's not clear how much of that they're putting into fine art. And that could be some view for lack of leadership in terms of the size of the market. But keeping in mind as advisors, when we think about this market, it is a big market. You know, the size of the market is roughly half the size of the municipal bond market. If you talk about, hey, we think we should put a client in municipal bonds, no one's going to look at you askew. If you say, I think we should put a client into Andy Warhol, you probably get a different set of looks, and there are a different set of risks we can talk about. But really the point is it's a big and growing and increasingly accepted market. Some of the other drivers really beyond what we talked about here, and some commentary on them. So the blue is kind of the drivers and the red is kind of the counterpoints. As a two-handed economist, we talked about it being a must-have and growth for the ultra high net worth and the intergenerational wealthy. In the red column, it may be overexposed. We've had flat years. There's a very scarce supply. You have this very interesting phenomena in the art market where pension funds might be the giants of kind of the investable securities market. They're big buy and hold. They have a lot of weight to put around. Museums are the equivalent in the fine art market, but unlike pension funds or Japanese banks or insurance companies, museums really do not sell their pieces, and they are really not supposed to sell their pieces, although there are some rules around what we call de-extension, opportunities where museums do choose to sell pieces. Often it might be, I donated a Picasso, you donated a Picasso. I know, Philip, you have far too many. So we both donate ones that are very similar. It was acceptable for a museum to potentially sell one of those. But the view was they had to rebuy a similar work or work in the same genre. We saw a very interesting thing that I wrote about called the de-ascension moment during COVID, where museums actually had a complete lockdown and a shutdown of revenue and did go to the market and sell some pieces. At the same time, that overlapped with the Black Lives Matter movement, and a number of museums made the decision to buy underrepresented artists, particularly Black and female artists. And so we did see art that was sold. We see in the far corner here a Lucas Chronic, Lucretia, this Chronic the Elder. The Brooklyn Museum sold this masterpiece during COVID lockdowns to continue to find funding. And the scarce supply, because museums, as they buy, that continues to limit the supply, continues to create a scarcity for fine art, particularly old masters. And then finally, we have a global asset that can move around. There's some significant tax strategies, particularly around free ports, particularly around donation strategies or strategies around gifting art to different generations. But many people feel that if they have to get on a plane and get out of town, that they can put some gold bars, some diamonds, and a Picasso on the plane with them and move assets that otherwise would be, only able to be moved electronically.
Hey, Mark, at this point, before
Yes.
we round out the art market and go to the individual investor sort of implications and opportunities, let me weave in an audience question. Stephen is asking here for a quick clarification. When we say art market, how do we define that? For example, does that include NFTs? Does that include AI generated art? What's sort of the standard definition we're using here?
It's a great question. It's a great question because when I started this work 20 years ago and started the teaching at Emory, I think 16 years ago, it was almost exclusively paintings and some sculptures, but paintings, usually oil on canvas, print. And we're looking at gallery reported activity, and we're looking at the auction market. And so that's how we define the market. Today, it's a much more expansive. So it does include AI generated art that is either sold through traditional fine art dealers or sold through the auction market. And we saw a very controversial AI generated Christie's sale with thousands of people writing in, asking them not to have the sale because because those people felt it would hurt the market to have art that wasn't generated by people, but rather was generated by computers. The sale was actually very successful. Christie's did go forward with the sale. But in answer to your question, Philip, it's really about the channel. And think of the auction market as kind of like the IPO market. It's a small number of players, but it's very high dollars. And the secondary stock trading market, which is the dealer market, makes up much, much more transactions, but often lower dollar volume. So we're capturing all of that when we're talking about the art market.
Mark, that's great. Thanks for that. Let's round out the art market at a macro perspective. And then let's get quickly to the individual, opportunities. But don't skip the tariff page.
All right.
Because students prior to this call gave me a little list of questions to ask, including, we're recording this on April 8th, 2025.
Yes.
Tariffs are one topic du jour. What are your thoughts, emerging thoughts, on the potential impact of tariffs on art?
So I'm gonna give two answers. One is a very practical, tactical, and the other is a little bit higher up, philosophical. Practically and tactically, traditionally art is viewed as a cultural good, and that tariffs generally apply to things that are essentially manufactured or mass manufactured. So you make 1,000 iPhones, but you only make one Basquiat. They're heterogeneous, not homogeneous assets. So traditionally, as this slide points out, they're traditionally exempt from tariffs. And the view from a number of market participants is that the tariffs that were announced last week will not apply to art. There has yet to be clarification, and there are some who are concerned that it will apply to art. So there's the potential for it to be subject to tariffs, which would obviously increase the prices. And as good economists, we know if the price goes up, demand should abate. More important, maybe not more importantly, but higher level, we find that in times of uncertainty and times of lack of clarity, which we have not only economically in the States at the moment, but also in terms of politics, in terms of geopolitics and realignment, that art is viewed, as we've said, as a store of value. It's viewed as a protection and a bulwark against chaos. And so things like gold, things like hard assets like real estate, farmland, but we also see art. And we've seen art really, Philip, for hundreds of years, if not thousands of years. If I conquered your civilization or your city, I would take the art, from, going back to obviously biblical times all the way through to modern conflicts. Art is viewed by different cultures and individuals as something that's important, as a store of value. So my view is, if the lack of uncertainty and kind of global chaos, which is partially exemplified by the tariff trauma or tariff trauma of last week, I think we can consider to see art as something that people fly to as a source of kind of stability.
Will be interesting to follow in the coming weeks and months for sure.
Now, there is, of course, we should say that this idea of the wealth effect, that if my stock portfolio is down meaningfully, and if I feel less wealthy, my decision to buy $1 million Agnes Martin is probably diminished.
Of course.
So where should we go? Maybe youth and individual collecting?
Yes, let's go there. Let's go from the macro backdrop, perhaps to the opportunities individual investors and their advisors face and contemplate when it comes to collecting art.
Absolutely. So we continue to watch why do you rob banks? That's where the money is. In the same way, a lot of people in the back nine of life in their 60s and 70s make up a big percentage of the collecting population. So we continue to be very interested in the work that we're doing among young collectors and where we see the growth. Even though we saw total turnover diminish the last 2 years, we saw a real growth in under $250,000 pieces, under $50,000 pieces. So in 2024, more than half of the active collectors were 36 or younger, um, which we find an encouraging trend. We also, as we mentioned earlier, seen real interest in digital and AI generated art, particularly among Gen Z. And we've seen a real explosion in the art market going online, not just digitally native art, but art that's being sold on online platforms. So when COVID occurred and we had lockdown, my view was no one's going to buy $1 million painting that they don't see. We've seen just the opposite. We've seen real growth in online platforms to buy and sell art.
You speak here of the different ways, people can access the art markets. And I know that over the past 2 years, new means of accessing and participating and enjoying full or fractional art have emerged. So can you
Yes.
talk briefly, I guess on the next page, of the
Yeah.
different channels people have available to them?
So there's a number of ways. So the first is obviously purchasing art um, from the primary or secondary market, right? So buying actual pieces of art. Another is essentially buying groups or even art funds, but you and 3 or 4 people can get together, or you and 3 or 4 people can get together and be limited partners to a general partner in a traditional, GP/LP structure to buy works of art. But what's really interesting has been the emergence of two kind of new ways for people to participate in the art market. One is through lending on art. Um, for folks who are not going to participate in the Sotheby's, Sotheby's just did a very large $700 million securitization of artworks and sold tranches in that debt, which different hedge funds and others participated in. If you're not going to participate in a $700 million participation, platforms like Yield Street have a business they call Athena, which makes loans on artwork that you can participate in those loans. So we think the debt participation, particularly on a fractionalized basis, is quite interesting. And then, as you mentioned, the emergence of the fractionalization of the equity in art has become incredibly interesting. The best example there is Masterworks, which is a unicorn startup that buys pieces of art. It securitizes them. It then does a securities offering. And what's so interesting about that is our data points very strongly to the performance of so-called blue chip art. Let's say art often that's above $1 million in price. If you have $100 million portfolio and you want to build a diversified portfolio of art, we would recommend you have 5, 6, 7 artists. If they're at the $1 million piece, that rapidly becomes 10% of your portfolio. That's very difficult to do. Fractionalization allows for a diversified portfolio to be created. I think the minimum you can buy into a fractional piece on Masterworks is $5,000. And so we've seen that become a really interesting trend in collectibles. And we've seen that fractionalization effort move all the way down to things like wine, where Vint takes bottles of wine and fractionalizes those. And while you and I can't enjoy a glass of it, we can enjoy the economic participation in it. And so the emergence of fractionalization, we think, is a really important trend. Masterworks has been off to a slower start than I think many would have expected. But now that they have been able to round trip a number of pieces, meaning not only have they been able to buy them, but they've been able to sell and exit at meaningful returns, double-digit returns, we think that the platform will continue to play an important role for folks who are looking for that second level of diversification beyond just alternative investments into what we call alternatives to alternatives.
Got it, Mark. Super interesting. I want to weave in two topical audience questions here before we move on. Number one, Michelle is wondering if there is a publicly available resource when it comes to art prices. I raised that here because I know that Masterworks spent years cataloging and building a pricing database across different genres and time periods and geographies, which I believe is proprietary to their solution. Are you aware of anything comparable that's public?
Yeah, it's a great question. So at Emory, we've built a database. There's a very famous database called the Mimosis Index, which is available through Bloomberg. But ArtNet has emerged as a little bit the Kelly Blue Book of art prices. And so I really recommend folks, if they are thinking about buying a direct piece of art, to check ArtNet and see what recent sales are. It generally, Philip, is only capturing auctions and then galleries who choose to list through ArtNet. So it's not comprehensive, but it is a good sampling. And I think you have to pay a small amount to see a small amount of data, like $100, a few $100s. So that's the best thing we have in terms of a publicly or generally available resource.
Mark, for the benefit of Michelle and other audience, can you name those two resources again?
Yeah, so ArtNet, which I believe is artnet.com. So just type into your browser ArtNet. That's the best resource. The Mimosis Index, which is MEIMOSES, is the most famous index for art and art prices. And it is on your Bloomberg terminal. It is owned by Sotheby's. And if I could, Philip, I'll speak for a minute about that methodology, which I think is really important. And then we can maybe round off there.
If you don't mind, let's do that later when you talk about the Emory Index and juxtapose it there. Let's real quick here, Mark, go to a question from David, who is wondering, in addition to individual ownership and the ways you list on this page, are there other REIT-like or LP-style ownership vehicles? He's mentioning 351 exchange funds or ETF outright that allow access to the markets.
So the answer is there are a number of art funds that are structured like traditional GP private equity funds. The public vehicles are trickier. In the past, we used to have Sotheby's as a public stock, which some felt they could use as a proxy for the market. It was taken private. And so there aren't great public or kind of liquid daily pricing opportunities for art.
Got it. Got it. Okay, super helpful. Thank you for that. I know you have about a dozen more slides prepared. I know your energy and passion around them. Mark, if okay with you, take us on a speed walk through those dozen pages. They will cover a lot of interesting areas. And then let's pause at 5:50 and use the last 10 minutes for the many great audience questions.
Absolutely.
Coming in, okay?
What I would say to those who are trying to advise people around art as an investment in their portfolio, there are three wisdoms that we encounter all the time. Art outperforms other asset classes, prices generally only go up, and art reduces your portfolio risk. And so for y'all's price of admission, I animated this slide that's not always true. What we And the reason, let me jump ahead a little bit. Those ideas are based on generally a idea from the MyMoses index and the data we get from the MyMoses index. And the challenge with that, which is a little bit different than the way we've positioned our research, is the MyMoses index, like the Case-Shiller index that we know, is a repeat sales index. So a piece of art is sold for $100, 10 years later, it's sold for $20, and we calculate the return. And then it's sold again 50 years later for $500, and we calculate the IRR. Pretty straightforward Excel, CFA type stuff. The challenge is what we have found is only great art gets sold multiple times. So there's a tremendous amount of survivorship bias when we look at the 250,000 repeat sales in the MyMoses index. And so at Emory, we've tried to introduce an opportunity to look at 10 million transactions and get a better sense for the market. And what we find when we don't look solely at repeat sales, because again, if I said to you, Philip, venture capital is a great idea, only invest in companies that are going to IPO, venture capital would beat any other asset. If you can buy Banksy and Basquiat and Keith Haring before anyone knows they're amazing, it really will beat almost any investment that we can, model or look at. What we do see, and so from that we get correlation tables like this, we get drawdown exposures, and when we build these correlation tables, the optimizer for optimal portfolios will start to include art at somewhat meaningful level. We've built what we call a hedonic index. So in the absence of multiple price points, and this research has been led largely by Roman Crossell, who today works at City University and collaborates with us at Emory. We are and he keeps a lot of this work at art.finance.com for folks who want to dig a little bit deeper. We've been able to build a database that gives us a different perspective in terms of what art does in a portfolio. Here's just some of that work. These are always interesting charts. If we look at this, just runs up until right before the pandemic. But art, if we take the top 500 artists by turnover and we run them against gold, we run it against S&P, we run it against things like real estate, we continue to see really strong performance among the top 500, which is why I mentioned earlier, Philip, that if you could have a strategy where you just bought blue chips, we feel that art is a much more stable, safer, higher return strategy than if you were to buy the latest Philip Hecker piece, which may not perform as well. So what we've found as we've done this work over the years is that as an entirety, art has pretty mixed results if you were to take the art market in totality and not just that top tip of those, artists who essentially get to do an IPO, i.e. they make it to Christie's or Sotheby's evening sales as kind of the pinnacle of financial achievement for an artist. Very few pieces account for a huge amount of the art market's return. And the more we study this field, the more we find parallels with venture capital, particularly early stage venture capital. So like a seed investor, I'm looking for 1 and maybe 100 investments to really make my career. And I know that a large percentage are not going to be financial winners. A lot of having come from and survived the hedge fund world, where a lot of the returns are kept and captured by the hedge fund managers themselves, the art market is not dissimilar, with brokers, dealers, and auction houses capturing a tremendous amount of the value and appreciation that occurs. With all that said, though, I would conclude before we kind of open it up that art is kind of unquestionably a real asset class for historical, financial, quantitative reasons. And as an asset class, we see strategies that are similar for other asset classes around catalysts, announcement effects, behavioral shocks. And so the same way we can use behavioral economics or momentum theory to look at prices for securities, we can show that those same methodologies can be applied to art as well.
Got it, Mark. I will ask you to toggle to 2 more pages before indeed we open it up for Q&A. And the first page I'll ask you to flash is the correlation page, which is kind of skipped over. And I want to frame that page with Brad's question from earlier on. We are circling back to you, Brad. You asked, what time horizon should people consider when they consider investing in art? And I raise it here because correlations matter, in particular over the long term. So here we go. Please talk about correlations and time horizons.
So there's a couple things. So the emergence of art flipping, particularly during zero interest rate environment, was high. Traditionally, we could show that you had to hold a piece of art at least 5 years. That number got very, very short 5 years ago. And we would see pieces that could come to market even twice in a year, which was very, very rare. Generally, like any illiquid or most illiquid investments, we encourage clients to think on a decade plus kind of time frame. So one of the challenges that I think Masterworks has struggled with is a lot of people showed up and put money on the platform, and they're checking every day, waiting to see, if they've made their money yet. When it's not a daily thing, it's really a almost decades-long investment. The people who do best in art are people who really are buying and collecting artists who they think their children and even their grandchildren will enjoy. And so if you can have an intergenerational perspective, we see that has a very high performance.
Excellent. Before you move on from that page, let me weave in Drake's question from the audience. He is wondering about the liquidity of art as an asset class. What would you compare it most to, given the structural, considerations that you mentioned earlier? And when it comes to liquidity, what are your thoughts there?
It is potentially, if we accept the premise that I've tried to advance, that it is an asset class, it is probably the most illiquid of the alternative asset classes. The market, as it were, for the top end art essentially is open twice a year, and very limited pieces can make it into the so-called evening sales. It is a highly, highly illiquid market that is subject to shocks. And so people who can hold through those shocks are the only ones who can kind of survive it. The introduction of leverage into the market has made the probability of forced sales go up if people are borrowed significantly against their collections. But it is a highly, highly illiquid asset. And so part of what we try to address it in the Emory work is, what is the appropriate premium I need to receive in order to take such extreme illiquidity risk?
Got it. The last page I'd love you to rest on is the golden rules page. Talk to me and assume I am a mid-career, smart, hardworking financial advisor that historically didn't have too much interest in or exposure to art as an asset class. However, my book of business, my prospects, are voicing, interest. What are some key tenets? What are some key attitudes? What are some key insights I could share with them? Let's walk through that, and then I have a follow-on, okay?
Absolutely. So the number one thing is that people have to buy what they like. And that doesn't mean you should buy only those, you should buy whatever you like. As we tried to talk about here, you should educate yourself. You should get advised. Clients should get advised. Provenance is incredibly important. Diversification is incredibly important. Artists like Damien Hirst, who were on a meteoric rise, have had very severe price corrections. A portfolio constructed around a single artist we think is very dangerous. But very few homes of clients have I gone into and they have Microsoft stock on the wall. Very few people, as they face the last weeks of their life, are calling us, telling us where they want their private equity funds transferred. Their artwork is something that we say has consumptives as well as financial value. It's something that people deeply enjoy and have enjoyed for millennia. It is part of the DNA of being a human being to be engaged with art. And so we find that that consumptive value, if portfolios are constructed with education, with the right advice, can be not only something that families enjoy and truly treasure, but also can be a financial benefit to the family in terms of the role it plays in portfolios and tax and estate planning and philanthropic planning. So we really think that in terms of asset classes, it's one of the most enjoyable things that clients can engage in. And it's something that they deeply have a passion about and want to be involved in. So I would encourage advisors to educate themselves and help their clients take a measured approach to engaging with the art market, the same way they would encourage a measured approach to any of the financial markets that they are recommending to clients.
Excellent. Thank you for those prepared remarks, insightful, thought-provoking, and helpful to us as we seek to serve our clients better on the important asset class that art is emerging as. Building on your last comments here,
Yeah.
Rhea Mishra is a former student of yours from Emory 2023. She says hello. And
Hello.
She is asking for younger advisors entering this space. What are some good resources? Are there some good websites? Are there some good knowledge bases you can point us to?
Yeah, no, it's a great question. You know, unfortunately, art is a large market, but it's one of the most unregulated markets. And so there are a lot of truth claims out there that are not verified. And a lot of resources are trying to sell something. So they're trying to convey a position. I think great books are ones like 30 Days in the Art Market. I Sold Warhol Too Soon remains a classic. The Mysterious Case of the $12 million Stuffed Shark are really good primers on how this market works. A lot of it is about access, like venture capital. A lot of it is about a momentum of what artists are hot. So I think those are great resources for advisors.
Awesome. Another audience question. Can you quickly share your perspectives on the seemingly fast rise and then fast demise on NFTs as a category?
Yes.
You touched upon it earlier, but what's the story there? What are the lessons learned from your point of view?
Well, as of April 1, not that it was April Fool's Day, but the punk that changed the world in August 2021, or I'm sorry, August 23rd, 2021 was when Visa purchased for its crypto punk collection, punk number 7610. Today, so they paid 150 grand in dollars for that. Today, you can buy kind of the most inexpensive crypto punk for 81,000. But as you know, these traded into the stratosphere with bids under 100 million, but still incredibly, incredibly high. My view is that money laundering had nothing to do with this. A public ledger, in my opinion, is a bad place to launder money. I think when people see big, big transactions, they assume kind of some money laundering activity. But the rise of NFTs to me is, I think that people are willing to experiment with collectibles. I think it was a very, very interesting experimentation. I don't think we've seen the end of it, but in kind of a tulip craze mania, we saw a real flocking to the asset based on a flipping mentality rather than what we try to look for is, can we look for data around historical performance of an artist? And so I think the main lesson is that we need to measure the performance of artists over multiple years, not multiple months, or even as some crypto drops were measured in minutes. We continue to see a lot of very weird speculative behavior, Philip. The Trump meme coins that are just essentially digital collectibles. We saw tremendous run up and crash down in those as well.
Gotcha. Next audience question here. Carl is getting a bit more technical. Forgive us, no Columbia, call without getting a bit more technical on the wealth advisory side. In particular, he's interested when it comes to the tax advantages or implications of museum donations for very wealthy families. What are some considerations there?
There's a lot of considerations. I'd encourage him to get in touch. I'll put up my LinkedIn. A few just very highlights. We've seen a real emergence in the sale donate of a collection, where a portion of the collection is purchased by the museum, thus establishing the fair price, and the remainder of the collection is donated. This is Emory's museum uses this structure. A number of museums use this structure, but it's a fantastic way to establish the price and the donation to a museum. I think the idea of a museum donation is important because for many collectors, the idea that the art will be taken care of and live on well beyond their time is very, very important. So we also see some non-financial benefits.
Got it. We have 2 minutes to go.
Okay.
Before I wrap it up, I'm going to ask you to share one more page again.
Yes.
And that is again coming from the audience, page 8 or so, which shows the ups and downs of the global art market. It has light blue columns.
Yes.
And you briefly
raise
that, share that, and maybe wrap up your observations on that page.
The art, the real telltale thing was Japanese buying of impressionist art prior to the Japanese depression correction, where we saw tremendous prices being paid for European impressionists that really have never recovered. The market, like NFTs, your question, Philip, around NFTs can be very, very volatile, which is why we need to separate the investment part of it and the speculative aspect of art. If people want to speculate on Bitcoin, NFTs, Banksy's, buy them and try to flip them, they can do that. People know the risks of day trading stocks. In terms of investing, we believe we're pushing up against long-term averages. I mentioned the COVID high, which we can see in 2019. Obviously, the lockdown low is a very, very low number. So in terms of wither the market from here, we like where we're priced. We think that, it is a volatile market, but it's one that is ever growing, more participants, and has stability and longevity.
Excellent. Mark, we could go on and on, but the time is nigh. We hope that you all enjoyed today's conversation. Mark, thank you for your time, energy, passion, and perspectives. Consider yourself now a friend of Columbia University. Next time you're in New York City, let's meet on our campus on the beautiful Upper West Side. And with your permission, we'll not only put the recording of this conversation on our website in the coming days, but we'll also add some of the resources that you mentioned, some links to great materials, including, for example, the seminal UBS report on the global art market that came out earlier this morning. That will be a good resource for many in the audience. Thank you,
Thank
Mark,
you so much. I appreciate it. Thank you all.
and you all have a great rest of the day. Bye for now.